once again to Carrie's Institute of Forex. Meanwhile, I will be taking us through some curriculum in the next few days. This class is actually an advanced classes for a group of people, but I just decided to give some of you the leverage to join so you also revisit the things I have taught you previously. When emphasis is laid, it brings enlightenment. So please, let's not take it for granted. Meanwhile, let's not also think we are familiarized ourselves with the concept. So quickly, I'll be taking us through IBDA, Introduction to Market Structure, quarterly shifts, institutional reference points, institutional order flow, entry patterns, and risk management. This will be our content for study in the next 3 days, and I hope that we'll finish in the 3 days and at most 4 days. So, but before we go further, like I said, we are starting with IBDA, so I think IBDA should be my first lesson. Good. So, anyway, the word IBDA means interbank price delivery algorithm. Let me come again. I said IBDA means interbank price delivery algorithm. So it's all about price delivery. Price delivery is what IBDA is all about. Now, for some of you who have been trading for a while, I'm sure you have seen how price has been reacting on the charts differently and in different events. This alone should tell you that price is not random. The movement of price on the chart is not random. Every time you see price moving from one direction to the other, it is because it has a specific goal. It has an intention. The institutions has a why as to why they should move from one point to another reference point. There is always a reason for their movement. So that means that all movements on the chart are sponsored institutionally. So that means price is not random. Let's take our minds from thinking that price is just random, it's just moving randomly. No, price is not random. It has a specific goal as to why it wants to move from one point to the other. So price delivery can be achieved in 4 basic ways. Meanwhile, in all the asset classes, irrespective of the asset classes, it can be achieved in 4 basic ways. Number 1, consolidation. Number 2, expansion. 3, reversal. Sorry, it's 3 that is retracement. Then 4, reversal. So consolidation, expansion, retracement, and what? Reversal. When you clearly understand this, you will not struggle with forex forever. In my opinion, understanding how price is delivered is key. It's first of all key before any other thing. I know most of you are eager. You want to see how I take trades. You want to see what I do on the chart. Yes, it's good. But everything we do on the chart is a product of your knowing. What do you know about, or what do you know behind the charts? It's very important. It's even more important than what you see on the chart, because you have to know it before you see it. And you have to understand these things. So, let's look at consolidation. Now, you must understand that in every trading day, price always begins from a consolidation. Okay? The opening of price is always from a consolidation zone. I know what consolidation means, so I don't need to go deep into that. Consolidation is when price moves inside the clear trading range and shows no willingness to move significantly higher or lower. When price consolidates, it indicates the market makers are allowing orders or contracts to build on both sides of the market. So in such case, we are anticipating an expansion in the near term. So every time we are in a consolidation zone, that we are actually anticipating an expansion in the near term. Yeah. We are anticipating an expansion in the near term. So what you are expecting to see is an impulse swing of price away from the equilibrium price level that is found exactly halfway point of the consolidation range. All this is English. Now let's take a quick recap. When price is moving, it usually forms an impulse swing, a retracement or corrective move, or a swing. This is a basics of market structure. We already know that for every movement, there's an impulse and corrective or correction, impulse, correction. Every time you see an impulse, you see a correction. Still the same thing. Now, this is a typical example of a chart showing a region of consolidation. You already see this region where outlined with a horizontal line showing something like support and resistance. Yes, this is what I mean. So every time we're in this type of range, what we're anticipating is what? An expansion in the near term. You see another consolidation on the chart, we're anticipating an expansion near term. So what is expansion? Expansion is when price moves quickly from a level of equilibrium or consolidation. When price leaves a level quickly, it indicates the willingness on the part of the market makers to reveal their intended repricing model. So you have to look for the order block theory the market makers left behind, okay, or near the equilibrium. For some of you who do not understand what order block is, I will teach order block in details also, okay? But for the meantime, just know that every time you're in a consolidation, you're anticipating an expansion, and while anticipating an expansion, take note of the order block that is near the expansion, or the order block that initiated the expansion. Yes, this is what I want to say. Take note of what? The order block that initiated the expansion. Good. This is another example of a chart showing consolidation and expansion at the same time. Now, see how I marked the order block that initiated that expansion move. The order block here, this is a bullish order block that initiated the expansion move. Price went back into that order block before it traded up and gave us over 100 pips of bullishness. Okay? The next I said is retracement before reversal. Now, retracement is when price moves back inside the recently created range. For example, just here, this was a consolidation. Price moved away, and then that return into the other block is called a retracement. I know we know that it's called a retracement. So when price returns inside the recent price range, it indicates a willingness on the part of the market makers to reprice to levels. Every retracement is a repricing. Actually, the real intention of the market makers is to do a repricing. It's called a repricing. Okay, nobody wants to buy an asset class or a commodity when the price is high. You buy when it is low. So for every bullishness, they want to reprice so they can buy more. So when you see them repricing or retracing, they're actually repricing so they can buy more. Okay, so again, when you see a retracement, look out for the fair value gaps and liquidity voids. In retracement, look out for fair value gaps and liquidity void. You don't know fair value gap, you don't know liquidity voids. I will teach them when I come to institutional reference points. But meanwhile, I'm just sensitizing you. Know what you are looking for. The key things I'm mentioning in a consolidation, when you see an expansion, look out for the order block that push price to expand. In a retracement, look out for the fair value gaps or liquidity void. So I'll come and teach fair value gap. But anyways, look at how price here after this expansion, this was a little consolidation. After the expansion, to take liquidity below these equal lows, price went into that other block and fair value gap as well as liquidity void. So confluences of three things are powerful before price traded away. Meanwhile, let's look at what reversal is. Reversal is when price moves the opposite direction of what the current direction is. When price moves the opposite direction, it has reversed, it has changed direction, they have changed the intention, their intention, I mean to say. So that means they now have a new goal. If their initial goal was to deliver price 100 pips bullishness, after delivering 100 pips on bullishness, they now change and delivered another 100 pips bearishness. That means they have changed, they have reversed. They have reversed. Okay? When price reverses direction, it indicates the market makers have run a level of stops and a significant move should unfold in the new direction. Look for the liquidity pools just below, just above an old price and below an old price low. In a reversal or before a reversal, look out for the liquidity pools just above and below an old low. This is where the market makers or the institutions usually will reverse into. Okay, that's where they will reverse into. Liquidity pool is an area of interest where liquidity is residing above or below equal highs or equal lows of a candle. When you see equal highs and equal lows, liquidity is residing above and below those areas. They are significant to you as a trader. For every equal high, there are buy stops residing above it. And for every equal lows, there are sell stops residing below it. All these are basics. Now, look at a chart showing us a clear example of reversal patterns. Price took out liquidity. Here we see how price took out buy stops liquidity, reversed. Price took out the sell stops below this low, reversed. Price took out the buy stops above this high, reversed. Price took out the went down swing low to take out the sell stops below this low, reversed. So you see how price has been showing reversal patterns, right? Those shaded areas are a run on liquidity above and below. When the bears are selling, they usually protect their trades with a stop loss called buy stops. And when the bulls are buying, they protect their buys with sell stops. So that means the institutions are interested in where there is buy stops and sell stops. That is where liquidity is residing. This is very important. These are the things that are driving price, that are calling price to move into them. So basically, this is all I want you to know pertaining price delivery. Okay, that's what I want you to know in regards to price delivery. So, excuse me. The next is an introduction to market structure. Now, market structure, in my opinion, is the most important factor when determining what side of the market to be on. Okay, if you want to know what side of the market to be on, market structure is an important factor. Although there is one more factor that is even more important than market structure, but understanding market structure in its real sense, because I've noticed many people draw market structure the wrong way. Yes, they are drawing the higher highs, the higher lows, and the break-off structures, but they are marking them wrongly, and it's the reason why they are making losses a lot. Okay? By market structure, what I mean is that you need to understand what forms the chart that you see. Okay? There are two basic types of market structure, the classical market structure and the narrative. Most traders trade using their understanding of classical market structure. Most traders trade using classical market structure. And the classical market structure is a retail concept, and you cannot succeed trading retail logics. The earlier you start adopting into institutional form of trading, the better for you, in my opinion. Even though I know what classical market structure looks like, but I also understand behind the classical market structure there is a narrative that you need to understand. Classical market structure is what talked about, or what talks about bullish market structure, bearish market structure. That this is what forms the classical market structure. And in a bullish or bearish market structure, they both have distinct characteristics to define themselves. A bullish market structure is made up of higher highs, higher lows, where resistance usually becomes support. And in a bearish market structure, lower highs and lower lows are formed, and support becomes resistance. I know you understand support and resistance also. Different time frames have different market structure, but from my experience, it is best to go with the higher time frame market structure, because that is where the big guys and the institutions, the banks, take their trades on. Okay, that's where they take their trades. This is a typical example of a bullish classical market structure. You see a swing low, swing high, higher low, higher high, higher low, higher high, higher low, higher high. So this high becomes this high, resistance now becomes support, resistance becomes support, resistance becomes support. This is what market structure is. Okay, so quickly let me just do a little briefing before we round up this session. So when I actually sorry, yes, when I was talking about price delivery, I said for every trading day we would usually begin with a consolidation. And there are few things you need to know happening in every consolidation zone. Remember I said that price has motives as to why it wants to move from one direction or the other. Okay? But assuming that the banks have intentions of delivering 100 pips bullishness, okay, for the day on GBPUSD, assuming that their intention is to deliver 100 pips bullishness, they won't just start delivering higher highs, higher lows until they achieve 100 pips bullish. They will begin from a consolidation. And we said when you see price in a consolidation, what is happening here is that they are accumulating contracts and orders. They are accumulating contracts and orders. So if this is where our 100 pips is supposed to be, if this is where our 100 pips is, before they start moving high into that region, they will first of all manipulate this, because there are a few things happening in a consolidation zone. They will first of all be a manipulation on the downside. If they want to deliver bullishness, they will manipulate the retail traders to take a sell. Then you will see that all of a sudden, because this run on these equal lows is actually a run on liquidity. It's not that they want to sell. It's a run on liquidity. So when they take out all the sell stops there, then they will now start delivering higher high, higher low, higher high, higher low. higher high, higher low, until he achieve that target. But I said, take note of what? The other block that does what? That does push price out of that consolidation. In a consolidation, first you want to see an expansion, then the other block, the liquidity gap, the fair value gap, liquidity pool, that pushed price away from the consolidation is where you want to take your orders from. I just hope this is understood. Now, when price has been delivered bullishly, I said for every expansion, we now see what? Sometimes they will consolidate again, maybe into Tuesday, if that was Monday. If they still have intentions of going high, they will take out this equal low, break, then continue. Then, if the whole target for the week has been achieved, okay, they will take out liquidity, then reversed to where? Here, there's liquidity there, there's liquidity there, there's liquidity there. So they will reverse. This is another block. They will reverse. This is how price usually forms on the chart. In a sell trend, you want to see a consolidation and a run above that region to take out liquidity, then break and start selling, consolidate sometimes. If they are going to reverse from this point, they will take out liquidity here, then reverse. Consolidate, take out liquidity, reverse. This is what is usually forming on the chart. I just hope you are understanding this. So, 4 things to take note. Every time you are in a trend, take note of where there is consolidation and anticipate an expansion. So, for example, if I know that institutional order flow is bullish or bearish, and I have seen price showing willingness to go lower, after a little drop, you see price consolidate, especially when they're about to transition between one session to the other. If this happened during London, let's say, for example, if that was London, if here was London, if that was London, and this is New York, where I shaded, no, let me shade it with blue. And this is New York session. This was London. During that time where they want to transition into New York, you see a consolidation. And when it's about time, they will break and continue into New York. Okay, let's say this is Asia, consolidation. When it's about London, you see a run of liquidity lower, then they will break structure, continue high, high, high. All these are basics I'm teaching you. Okay, I just want to be sure we understand all these basics before we start the real thing. Okay, in identifying market structure, there are 3 ways to identify market structure. Most people you can identify market structure using the wick. I said there are 3 ways to identify market structure. Number 1, you can use the wick to identify structure, and the wick also. Wick for structure, identify structure, and wick for break of structure. Wick for break of structure. Number 2, You can identify market structure using week for structure, week for structure, sorry, for structure, and body of candles or candle body for BOS. Then you can use candle bodies. That's the third one now. Candle bodies for structure, candle bodies for structure, and candle bodies for BOS. So guys, these are the 3 ways you can identify market structure. 3 ways to possibly identify market structure using the wick for structure, wick for BOS, wick for candle body, wick for structure, candle body for BOS, then candle body for structure and candle body for BOS. Now, the wick for structure and candle body for break of structure is what I use and is accepted by over 90% of professional traders. It's the most accepted form of identifying market structure. But most times we have problems with identifying which of the wicks is actually the most valid wick to break structure is where we used to have problem. Okay, identifying which of the wick is the most valid wick is usually where people have problem. For example, in this chart, let's quickly. Sorry, actually, please, are we seeing this chart now?
Yes.
All right, thank you. I forgot I was sharing my whiteboard now. I just checked out now and noticed. So, just like I was saying, oh boy, who is in the kitchen? Put off your mic. So this is what I mean. So let's quickly take a good look at how to identify market structure using wick. You can clearly see that we have been in a bearish trend all through. I quickly want you to take note of this high. Remember, I had taught you that if you want to see reversal, we want to see a run on liquidity. Previously, price was bearish and then price retraced. Okay, after the retracement, we now see price continue the bearishness. So, but in that move, I can clearly see how price took out liquidity here, took out the buy stops residing above that high. The buy stops residing above that high. I can clearly see how they took it before they continued bullish. Now, which of the high is the most valid high? Remember I said I'm interested in using the wick for structure and candle body for break of structure. Wick, structure, candle body, break of structure. two things I'm going to teach. I may not teach market structure again. This may be the only time I'll teach market structure. So I want to use the wick to identify structure, and then candle bodies for break of structure. Candle body for break of structure. Good. So I want to use the wicks. The wicks to identify structure. This was a low. This was another high. So we have formed a high, higher low, higher high, right? At what point do I consider this a break of structure now? It's at the point where I now see that this low, the low of that candle, has been broken through by a close of body of candle, not wick. So before I will consider this low broken, I will must see the body of the candle close below that low. Do you see it clearly here? That's the only time I will now agree that I have a break of structure. Otherwise, every other thing is false. Every other thing is false. It's at the point where I see the body of the candle closes below the low. I can use wick to identify structure, but I don't want to identify break of structure using wick. You can see all these points here. You can see how the wick pierced through this low and still traded up a little bit. Pierced the low about twice. 1, 2, and then the third candle closed below before we now saw a significant move lower. Okay, if we move forward, moving into forward, if we move this forward, you will see how price took our liquidity again. Before price reversed into this other block, price took our liquidity. This is a very powerful setup. It's called stop raid. Okay, it's a run on liquidity. There's an equal low here, equal low. Price took out the buy stops. I mean the sell, the buy. Is this sell stop? Sell stops residing below this low before they traded up. This was more like a consolidation. Price traded up, broke what high? The high that this was the high that pushed price to form to break the previous high here. This high was the high that pushed price to break the previous structure. So this is my valid high. Did I see a break of structure? Yes. What candle broke structure? That bullish candle here. Trying to zoom in so you see. This bullish candle broke structure. Then I now see a sharp retracement before the move, the big move. I'm just trying to help you identify structure correctly and break of structure. So every time I'm identifying structure, I'm careful not to use wick as break of structure. Rather, I'm careful to use wick for structure, candle bodies for break of structure. The most valid high is the high that is the high, or the most valid low is the low that pushed price to break a previous structure. That's when you have a structure in itself. The most valid low is the low that pushes price to break. The most valid high, sorry, is the high that pushes price to break structure lower. For example, this was a high. This is another high. This high pushed price to break this structure. This becomes a valid structure. Okay, because it took out liquidity on sell side. On sell side, it took out this liquidity. So I'm interested in what is happening here. So if I see price now comes to break this high again, I know there's another break of structure or any other thing downstairs. Let's look at another thing here. So here again, you can see how price has been trading and forming structures. This is a low that was broken by price because the candle body closed below this low. I see a retracement into something. I will teach that during the course of the training. But meanwhile, while I was teaching you, I said in a retracement, I want to take note of fair value gaps and what? Liquidity void. So some of you who know fair value gaps, this is a very powerful setup because this was a move away from a region that took out liquidity and a retracement into fair value gap, and price has been selling down. I see another structure here. Why this is a valid low is because it took out this low. Okay, so this is my next low. Where is your next high? This only becomes a high if it breaks this low. Otherwise, this remains my valid high. Okay, until we see this retracement up comes to break structure lower, this will remain our valid high. So, but because this took our liquidity on sell side, this becomes our next high. Then another high, and another low, another high. This becomes a high because it took out what low? Which low? This low. It broke this low. So this becomes a high. This becomes a high because it took out this low. This becomes a high because it took out this low. Okay?